first thought that comes to mind when a new user hears the word cryptocurrency is anonymity. There was an early misconception that because cryptocurrencies like Bitcoin were anonymous and untraceable, they served as a haven for criminals. The idea was that users could conduct private transactions with cryptocurrency that banks, governments, and law enforcement agencies couldn't track. Even though cryptocurrencies do offer privacy, details like an investor's name, address, and phone number can still be traced. The use of cryptocurrency has grown significantly during the past few years, with more and more individuals using cryptocurrencies as a form of investment and payment. It has experienced an exponential rise. Bitcoin and many other cryptocurrencies are based on blockchain technology, which offers total decentralization. These digital assets can operate independently of any oversight or direction from a centralized authority. The concept is that only two people are participating in the activity, since Bitcoin permits direct peer-to-peer transactions done via the internet. Banks, governments, or middlemen are not required. Although this appears to set up the perfect framework for privacy and anonymity, this year's buzz and other examples paint a different picture of crypto transactions. Bitcoin and other cryptocurrencies have been hailed as entirely private, untraceable, and tamper-proof digital assets since the advent of blockchain technology, nevertheless. But how much of this is true? Let's investigate. All transactions are recorded on a distributed ledger thanks to Bitcoin blockchain technology, which also ensures complete transparency. Everyone has access to these ledgers, which are available to the public. As a result, Bitcoin transactions may be tracked. However, certain cryptocurrencies are touted as being 100% anonymous. Any assertions of completely anonymous transactions, however, needs to be taken with a grain of salt. We know that we can always get to the bottom of it through forensics analysis. Therefore, we must treat any cryptocurrency that asserts that it is 100% anonymous with a grain of salt. To turn Bitcoin into dollars, you generally need to find a company that provides this service, such as a cryptocurrency exchange, a money transfer service, or select banks. These types of business typically follow the Know Your Customer guidelines. Therefore, identification verifications is necessary to use the service. Regardless of how anonymous or pseudo-anonymous Bitcoin may be, transacting it would not be anonymous in any meaningful sense, since the services that move Bitcoin into dollars are not anonymous. Users can track any actions on the blockchain using resources known as crypto explorers. Additionally, the sum sent and the addresses concerned in the transactions can be tracked. However, these transactions do not reveal real-world identifying or personal information. You can only track them back to the user's public key. Therefore, even if blockchain explorers can aid in tracking transactions and obtaining wallet addresses, it is difficult to determine the identity associated with the address, giving the user pseudo-anonymity. The only way to identify transactions on a blockchain is by using a public key, which is a series of alphanumeric characters. Bitcoin transactions are pseudo-anonymous thanks to this key. This implies that while other people can view your transactions and your holdings, they are unable to determine who you are in the real world. This changes, though, if you want to purchase a cryptocurrency debit card or exchange your Bitcoin for cash or other tokens. For any such services, you must first register with the centralized cryptocurrency exchange, decentralized application, or crypto bank. To become a customer of these platforms, you'll probably have to go through a KYC procedure. By doing this, you establish a connection between actual information and a wallet's public key, which can then be used to learn more about the person who is represented by the wallet's public key. But can Bitcoin be withheld? The fact that transaction records and individual cryptocurrency holdings cannot be altered or tampered with is one of the biggest advantages of blockchain technology. This quality is referred to as immutability or censorship resistance. Due to the decentralized nature of blockchain technology, nobody has access to another person's money or data. As a result, it is impossible to freeze, hold, or modify on-chain tokens in any way. Perhaps turning down internet connectivity nearby would be the only method to prevent a user from accessing their on-chain funds. However, once you transfer your money to a crypto exchange, landing site, or dApp, all of this security disappears. After that, a centralized authority becomes involved and has the power to freeze funds. The wallet of a user may occasionally be frozen by a centralized trading platform. This commonly occurs if the user is engaged in illegal conduct. The developers may be contacted by government agencies to freeze a specific address. Developers ban the address, stopping users from sending or receiving cryptocurrencies. In some cases, the feature to blacklist an address can be misused by scammers. Scammers frequently utilize this feature on decentralized exchanges to prevent the sale of tokens purchased. This will raise the cost of the aforementioned token and entice investors to the enterprise. Once the prices reach a certain point, the con artist sells their tokens on the open market and vanish with the money. So, how are suspicious crypto transactions reported? The term KYC is a standard used by the financial services sector to prevent money laundering and other types of financial crime. To create a customer risk profile, which is used to recognize and report suspicious activities to authorities, institutions covered by the Federal Deposit Insurance Corporations, for instance, must have a clear relationship with their clients. That implies that to be insured, banks and other financial institutions are required to maintain a record of the personal information of their patrons. Cryptocurrency exchanges operating in the US have embraced KYC rules even though the FDIC does not insure it. Both Coinbase and FTX US requires customers to confirm their identities. It is also important to note that the FDIC is researching new regulations for crypto assets in collaborations with other regulatory organizations. Cryptocurrency offers a certain level of anonymity. Maintaining this anonymity and carrying out untraceable transactions is getting harder with the new KYC regulations though. Cases of frozen wallets have also become common these days. The unpredictability of the compliance and regulatory landscape for cryptocurrencies is one thing you can rely on. Business dealing in crypto assets must be ready to adapt quickly, embrace new standards, and shield their operations from regulatory scrutiny because anti-money laundering legislation is constantly evolving. Using technologies that compare consumer data to Bitcoin transaction histories, criminal activity can be stopped in its tracks. This can help you spot high-risk customers with ease, maintain AML compliance, and stay clear of the stigma attached to cryptocurrency money laundering. The chances of someone tracking your account, finding out who you really are, or freezing your account are incredibly slim. These jobs need specific equipment and expertise and frequently involve law enforcement authorities looking for criminals. Alright guys, that's all for today. If you found this video useful, please give us a thumbs up and click the subscribe button if you want to see more.